Hi, thanks so much for tuning in to BQ Prime. We're in conversation with DP Singh, the Deputy Managing Director at SBI Mutual Fund, and there's lots to talk to him about. First of all, sir, thank you so much for taking the time.
Thank you. Thank you very much for having me on this.
So
Alex.
I do want to start by asking about uh, bond yields and fixed income strategy, because really that is the talk of the town, not just here in India, but globally. Overnight, of course, you had the bond yield on the 10-year paper in the US cross that 4% mark that a lot of people have been looking at. And the signs are that they are nowhere close to done on the rate hiking scenario. So from that perspective, in this context, and based on what you're seeing here in India, what, according to you, should the fixed income strategy be for the Indian investor?
I think for Indian investors, Indian bonds itself are quite attractive rather than looking at the US bond. Because if you look at the US bond yields, which are in the shorter term, in 1 year, it's 5%, and thereafter, it's absolutely inverted, 3 year, 5 year, in the range of 4% only. And in the 4% yield in US, and then so many other things, LRS, everything involved, the 7.5% kind of yields which are prevailing in India in the longer duration are much more attractive than the parking or locking the money in the USA. So my call is, in a shorter term, yes, 1 year it's fine, but beyond 1 year, it's not that attractive. Our own bond yields are quite attractive for taking the benefit of any interest rate cycle movement on the other side.
So I'm curious, sir. So let's focus on bonds in India and bond funds in India. There is a theory that is being propounded that since the yield curve is more or less flat, and if you look at bonds all the way from the 5 year tenure all the way up to 10 year, there is not too much of a difference in the yield there. So
Yeah.
it's not as rewarding at this juncture, some people are saying, to take positions in the long duration funds. Do you agree with that? Is there a benefit in locking in yields at those high levels?
Yeah, definitely, Alex. When the point is, are you locking in your money to take the benefit of coupon, or you are playing the capital gain, or you are trying to get the benefit of if the interest rates move down? So if you have to take the benefit of capital gains, which will accrue if the even 1% interest rate comes down over the period of 2 to 3 years, then longer the duration, higher will be the capital gain.
Mm.
So it's on individual. It's an individual. If you are trying to lock in the yield, then it's up to you whether you want to do it for 5 year or 10 year, or how much long you can lock in your money. But if it is a capital gain game, then definitely longer the duration, better will be the capital gains.
So it's an interesting play, right? Because I think people invest in debt mutual funds for one of two reasons. Either they're looking for stability and protection of capital, and they're deploying that in a certain portion of their portfolio, or they take a small allocation and make a tactical bet if they're understanding the interest rate scenario. So what you're saying
Yeah.
is, as a tactical bet right now, considering that interest rates are possibly close to the peak, this
Yeah.
might be advantageous. That's right?
Yes. Yeah, that's right. That's right. And second, as far as the credit risk is concerned, that is also not playing too much because the risk premium on corporate bond is not very high. So
Hmm.
there's no fun getting into the big credit risk because the yields, 10 year, see, GSEC yield or 10 year AAA rated paper are almost, the gap is very, very less, 30, 40 basis points only. So it's always better to be on the GSEC or the SDL side, and take the benefit of the capital gain whenever these accrue. But you must have a visibility of clocking it for 3 to 5 years. If
Hmm.
even if you are taking 20 year, 30 year bet, but even then, your one thing should be clear that you may have to lock up for a little longer period because we don't know, because we have the examples earlier also when the yields continue to remain flattish for a longer period, 2 to 3 year, 4 years before it's getting downside. So
Yeah.
that's the only caution one has to have. But in my view, longer the duration, higher it will be, and especially with the new category of fund like target maturity funds.
Hmm.
This is a beautiful opportunity for people where the liquidity is also available. Cost price also is very attractive, and the benefits of all when capital gains is there. So that's a very good play.
One of the symptoms, since we started speaking about bond yields, one of the symptoms of that increase in bond yields globally is volatility in other asset classes, particularly in equity. So you've seen significant volatility. There is expected to be pressure from overseas on India, though India has been resilient overall. Uh, what I want to ask you before we launch into the other segment of this conversation is, with this increased volatility, what should the investors' benchmarking of expectation be heading into the new financial year?
I think 7.5% is the best thing, because going beyond that, even if we talk about the bank FD rates also, to the senior citizens especially, they are getting 8.5% kind of return also, but that is for a very short period. Nobody is giving you 5 year 8.5%. Everybody is giving 1 year, 2 year max, 700 days, 800 days.
Sir, but I'm
So
asking
that
about equity, sir. I'm
equity,
asking about
okay.
equity.
Yeah, equity, I think, see, we need to be disciplined investor there. That class is very much there. Valuations have also become quite fair now, and there are a lot of stocks which are available at the fair valuation. So investing in mutual fund through, in equity through mutual fund route, I think this is the best time. Though there's uncertainty, we don't see too much of lumpy flows, but that is the period when you put in money and you can take the benefit. Maybe you can spread it over the period of next 3 to 6 months. That's it. But over the next 3 to 5 years, I think whosoever enters now will get very good benefits. Especially in our market, see, one thing we have to understand: lots and lots of new businesses are coming up. We're getting into the listed space, and the benefit will come. That the phobia of that the new age tech companies is not there now. It's absolutely businesses and the financial which are at play, and that is the best time to be it. There's no euphoria kind of thing, and that's where the fund managers can create a lot of value.
So, one a particular group of investors or a type of investors look for relatively low volatility in the equity markets. And one way to play this is through dividend yields.
Yeah.
What do you have to say with regard to that strategy?
No, actually, incidentally, see, there's a category of dividend yield funds in mutual fund, and we were staying away from that for a long period. But we spent almost 6 to 8 months of studying the behavior of the companies who are giving dividends, and especially those companies who are not into the large cap or PSU space, but which are into the mid cap or small cap space. So what we have observed is the volatility in the market and these kind of stocks are very, very resilient, because they are having very solid businesses, very solid cash flows. Naturally, the companies who are having regular cash flows and having good outlook of business, they are the people who are able to give good dividends. So we thought, we did some back testing for the last 5 years and saw that these companies are actually very, very resilient and can give a very, very good within the relatively very risky within the equity class. So when we got convinced, and then we launched this fund, and we are sure that whosoever will be investing in this fund now or when it's open up, since it's an open end fund, they will definitely make very, very good returns. And overall, the earlier funds also who are there in the market, if we look at those funds also vis-a-vis the market, they are outperforming the general diversified funds.
Sir, based on the research that you've done and the study that you've done, what is the kind of yield that these companies have generally given, and what should be the expectation if one gets into these dividend yield funds? Essentially, about 80% of the portfolio gets put into these companies that generally give high dividend yield.
Yeah.
But what is that average dividend yield that an investor should look for?
See, average yield as on date is around 2.5%, 2.5 to 3% max in a good company. But at the same time, there are some companies which are giving as high as 9 to 10%. But here we are not looking at the yield alone. We are looking at the businesses, because incidentally, these companies who are paying dividend are more resilient to the market volatility. So that's why it becomes a class. And second, there's another taxation angle to this. As you are aware, the dividends are taxable in the hands of investors. today. Anybody, if you and me have some stocks in the company, and if we get dividend first, TDS is deducted, then it's fully taxable as per our see whatever our slab is. But in case of investment in these companies through mutual funds, it's beneficial because the mutual fund by statute are the tax-free entities.
Hmm.
And whatever dividends come, those are invested in the scheme, reinvested, so that portion benefit is there.
So it
And the
becomes
cash
long-term capital gains, is it?
no, for the mutual fund schemes,
Hmm.
it comes. It's a tax-free entity. Full money comes. There's no question of capital gain at that end. It's a
Okay.
cash flow.
But when you
It's
when
full.
you when you
Yeah,
get money out of the scheme,
I'm
it
I'm
falls
coming to
and
that.
sorry,
I'm coming
yeah,
to that. I'm
yeah.
coming to that. So what we are planning, what we are advising people is don't. You can plan a percentage, 5%, 6%, 7%. If you are having now 10 stocks which are giving dividends, you get 10 checks, 10 TDSs and all. Here you put in this scheme and fix a percentage for yourself, say 5% or 6% annually. Take it through SWP route, systematic
Okay.
withdrawal plan route. That becomes highly tax efficient because only the gain portion on those units which will be in cash, there will be a long-term capital gain tax if it is after 1 year. So it's become very smart tax planning tool. That you can get the cash flows also. It becomes recipient as well. You will get only one cash flow. You know the date. You know the percentage. So everything is aware. And
So
then capital gain in
predictability.
any case will come. Predictability of cash flow is there, and then capital growth, whatever is happening in any case is happening. Less volatile, disciplined cash flow, and the opportunity of having better capital gain, growth in the fund. So all these three are win-win for everybody.
Fantastic. What, according to you, is the allocation? And this obviously would depend on the individual, because I think there are a lot of senior citizens, there are a lot of retired individuals that choose to have quite a significant portion of their equity portfolio in these dividend yielding stocks because of the regular income that they provide, right?
Yeah. No. I think this is the best tool now, especially after the tax law changes. One should not keep the very just on the basis of capital gains. Take the example. There are so many stocks which are there, but they're giving dividend, but they have not moved at all for 4 to 5 years.
Mm.
That's what mutual funds do. That we look when any such company which is not growing at all, we'll keep it out and we'll take another good dividend paying company as well as the capital growth opportunities there. I think we are trying to educate people to the benefits of this. But there are sometimes psychological issues also when my forefathers were holding it, so I want to continue. So we can't play with that. We say, okay, keep some percentage of that, but
Mm.
remaining part let it be played by through the dividend yield fund, because this is in any case is much more beneficial to you. Adjusted to expense also, it will be very good, because when they do any transaction in the market also, equivalent to or more than expense, they in any case are paying as a brokerage. That's the point which we wanted to
Sir,
educate people.
and we've spoken about this at length, the benefits are there, but it's taken SBIMF quite a while to launch a dividend yield fund. Why is that? You
No,
didn't
see,
launch it for a while.
we don't want to do it for the heck of it,
Got it.
unless and until we have the conviction. See what is happening after we became the largest. See, any company which is coming with the IPO, they reach out to us for the subscription. The one basic filter which the fund management team talks to them about is what is your dividend paying policy? What
Hmm.
are you? How you are paying going to pay dividend? Actually, now we feel that with our size, we want to change the thought process of the corporates who are coming into the market,
Hmm.
and we are able to force them. Some people had the habit, no, we will not be giving dividends. We want them to articulate and document it. And if we have more money lying in this fund, because we want to create a portfolio like a flexi cap, not like a large cap fund or PSU fund kind of thing, it will be over the period of time more of a flexi cap time, and which we want to change the behavior, which we feel is our responsibility to bring in that perceptible change in the corporate world, that when they are coming out with the IPOs, they should have a very clear cut dividend paying policy. Ultimately, people are putting their hard earned money into that, and they should benefit. Capital gains are one, but they should be part of the cash flows of the company also.
Sir,
So
then
we want to do that.
would it be fair to assume then that the approach to creating a basket of dividend paying stocks will not be the traditional approach where generally people have looked at PSUs that have traditionally paid high dividends. But will this be a transitional approach? I know that your fund manager perhaps will have more insight on this, but as a fund house, is that the approach that you will have to make a transition?
Definitely, we have this approach because in the PSUs also there are a lot of value companies. Value is also playing very well. It's a combination of flexi cap plus value plus the large cap PSU kind of thing. Because PSU in any case, when we look at the index also, the NSE dividend yield index, only 15% are the PSUs. The remaining are the other companies. But the remaining companies, what are the Ps, what are the valuations, whether we are convinced about those valuations or not. If the valuations are very, very costly, though it is a good dividend paying company, we may not opt for it. We'll look for other companies. So what you are saying is absolutely right. It's a transitional kind of thing. And second part is this category is very, very small as far as India is concerned. Yeah. It's just as on date only 10,000 crore category. And there, if we look at in US, there's one fund which is called Equity Income Fund, which is done on the same strategy. That fund itself is $50 billion. That is 4 lakh crores fund in US, right? And we are the whole industry is 10,000 crore. We feel that there's an opportunity to take it to 100,000 crore in a short period. And we want to activate this. This is not only we are doing it. We want to bring in this concept into the market so that everybody works on it and create another category which is very, very big.
Fantastic. DP sir, always a pleasure speaking with you. Thank you so much for taking the time.
Thank you, Alex. Thanks a lot. Have a good day.
Yeah, you too.
Thanks.